What's up, guys? Remy here with another financial statement analysis, and we're going to be continuing off from our last video, which was an analysis of the German company Nell, and this one is the second in the series. I think there's about 10 stocks, and I think not. Well, there was 10 stocks, but one of the stocks has been delisted, so there's 9 stocks left in the group of German energy companies. So this is the second that's going to be evaluated, and without further ado, we're going to get into the financial statements. So that is the cash flow statement, the income statement, and the balance sheet. And then we're going to analyze. We're going to conclude the video with a description as well as a kind of score as to how good the company is, and that will be it for this video. So as we can see straight away from the income statement, the past 4 financial years suggest that the company's earnings growth the company's revenue growth is not very consistent, but it's somewhat consistent. It's pretty high, but more importantly, the profit margin growth or net income growth is quite good. So what I mean by that is every single year the company is growing in terms of net income, not by a massive amount, but growth at a decent percentage is good. Growth in general is good. A lot of companies don't grow at all. Their net income figures over consecutive financial years are kind of all over the place. So it's a positive sign so far to see that this company's net income growth is positive. So we're going to get into the balance sheet. So in future videos, when I get a bit more experience in terms of analyzing the full financial statements as opposed to a brief that we're looking at today, I'm going to be explaining in more detail each different segment of each financial statement. For example, if I go into the income statement, we're going to be analyzing each segment, like the total revenue, the breakdown of the total revenue, the gross profit, the total operating expense, and each subsection. So that'll be more interesting and more fun, hopefully, for you guys. So yep, let's get into the balance sheet. So the balance sheet is a look at the company's debt to asset ratio, and what we can see so far is what we're looking for to start off with is a low debt to asset ratio. So the company having not so much debt as compared to the assets that it manages. So as you can see here, the dark purple figure suggests the liabilities, and the light purple figure suggests the assets. So as you can see, the assets compared to the liabilities is very low, which is awesome. It means that the company isn't over leveraged and doesn't have a high liquidity risk. So let's look at the cash flow statement. So as you can see, this one's a bit more confusing, it's a bit more jumbled, but we're going to go into it and see what is actually going on. So we look at the net change in cash figure at the bottom, which suggests how much cash the company's left over with after the net income. So after it's made all its profits, paid all its taxes, how much is the company left with after deciding what to do with that cash, so whether it's giving it out dividends, etc. So the company's left the current financial year it's left with 25 million, previous negative 7.35 million, and the previous 10.5 million, and the previous is negative 34 million. So 2 years, so we have 2 years that are negative and 2 years that are positive. So let's just see exactly what the company is doing with the cash. For example, let's pick a random year, 2019. So it's not necessarily a bad thing if the company is left over with a negative net change in cash figure. It just depends on what the company is doing with the money. So we start off the cash flow statement with the net income, which is the starting line. We can see that the company has paid tax, paid interest, some changes in working capital, has pretty much wiped out all of the cash. Pretty much wiped out all of the net income. So the changes in working capital have wiped out all of the net income. So the starting line from the cash From investing activities is negative 13 million. Capital expenditures 13.22 million. So overall, let's just go over the heading. So cash from operating activities, so they gained 34 million, so that's about 55 million they should have. Cash from investing activities, so they lost 30 million from $30 million of cash. 30 million euros of cash due to investing activities. So they invested 13 million in investing activities. And so that should be about 40 million. So the cash from financing activity, they lost 55 million. So they paid out 21 million dividends, and they lost 34 million financing cash flow items. So that's where you get the bottom line figure, net change of cash of negative 34 million. So that's pretty much what we've analyzed so far in terms of the company's financial statements. Overall, I would suggest this company is okay. We're going to quickly check the key ratios, just which is an overall assumption of the company's financial health. So the market cap is 1.05 million. The revenue figure is 1.08, so already close. Which also just suggests that the company is probably undervalued simply because the market cap is selling for under less than the revenue figure, and considering that the company's net income figure is quite a decent amount, and also the debt to asset ratio is quite low also, then it just could be quite a bargain. And also the market cap is over $1 billion, so CropEnergies is, I think, is a decent amount. So dividend yield also is a decent amount, not quite what we're looking for at 5%, but it's just under, which is awesome. Also, we're going to be making a dividend portfolio later on. If you guys are interested in me making a video on how I make portfolios / pies, because we're using the Trading 212 app, then just comment in the section below and I'll make a video on that. So PE ratio is 11 which is really good actually, 11.71. We're looking for around 10 or lower. In this current market economic situation, 10 or lower should be not predominantly the P ratio that you see, but it should be more common simply because stock prices have just plummeted for most stocks, if not all. Well, not all, but probably most stocks. So earnings per share 1.02 euros. Let's check the market price. The market price. So that's about 10%. So the earnings per share is about 10% a year. So you should expect the company to grow about 10% a year, which is pretty healthy. That's about the average. The beta is 0.76, so 76% of the average beta market volatility. So this company is really good actually. Funny enough, I invested £1, like I didn't realize, and this increased by 17%. This was less than a year ago, so really good. I'm probably gonna add this to my portfolio because it's a decent company. I wouldn't put too much of a stake. I won't make it too large a stake simply because the market cap is too small. But yeah, this is a decent company. Without further ado, I'm gonna close this video. Thank you guys for paying attention, and I'll see you in the next one. Any comments, suggestions on how I can improve, anything you would like to see, please put it in the comment section below. Peace.